Good afternoon. As Scott said, I do have the honor of serving as the Vice Chair of Programs for the Global Interdependence Center. And as David Kotak mentioned earlier, this relationship between the GIC and the BBC has been going on now for quite some time. Just want to say in person and in public to Justin and Scott and all the BBC members, thank you for this relationship. We couldn't do it without you. It's been wonderful, it's extraordinary, it's meaningful. I think it does have impact, and we hope it continues for many years in the future. So thank you very much. All right, panelists are seated. So we're supposed to talk about investment outlook and cryptocurrency. And I was trying to figure out, how do we start off a conversation like this, particularly after some pretty remarkable speakers today. I was digging through my briefcase and I found a card I hadn't seen in about 15 months, so you can figure out last time I looked at it. It's called Billy Beane's 5 Golden Rules. So let me just share this with you because I think there's some pretty tight corollary between baseball and investing. So golden rule number 1, change is always good. Thank you, Paul McCauley, who's calling for some change. But you always have to be upgrading. Rule number 2, the day you say you have to do something, you lose your choice. Rule number 3, know what every player is worth and put a dollar figure on it. Rule number 4, know who you want on your team or in your portfolio. And never mind who they say they want you to trade. Just know what you want. And rule number 5, every important deal will be scrutinized, but ignore the critics. So where there is wisdom in baseball, so too there is wisdom in investing. And we have 3 very wise men to help walk us through that today. So I'm very happy to introduce Jim Bianco, who's the president and macro strategist of Bianco Research, based in Chicago. Richard Mayo is the chair and chief strategist for Game Creek Capital, and Paul O'Brien is the former deputy chief investment officer of the Abu Dhabi Investment Authority. So what I'm going to ask, gentlemen, if you would, maybe take 7 to 10 minutes. Would like you to just lay out your view of the world, and then we'll come back for some Q&A from the audience. So I think we'll go in order, if it's all right. We'll just go as we're here. So Paul, we'll start with you. Dick, you'll go second, and then we'll go with Jim. Thank you.
Yeah, good afternoon, everyone. Also share my thanks for being able to come back here. I believe I'm the last speaker named Paul, at least for today. So we will see. What I want to talk about briefly, and we can follow up later, is investing in a time of inflation. Because that's what I think we face. Between John and Megan, I'll take John's forecast. But as an investor, you really don't want to listen to economists. You want to listen to the market. And the forecast that matters is the forecast the market's making, because that's what you're playing against. And I checked this morning, but it's been true for a while. The market expects inflation to go back to 2% and stay there basically forever, and for that to happen pretty quickly. So that's what you're betting against. If Megan is right, and she might well be, that's not a view that's going to make you a lot of money relative to a neutral view. If John's right, you've got some challenges. And particularly, I think if Paul McCulley is right, and I would agree, because I think when we talk about inflation, we want to think of it as climate, not weather. What we're having now is weather. We're having a price storm. It might blow over, it might not. But it's a short-run phenomenon. The thing you have to worry about, and the thing I believe is going to happen, is what Paul was talking about. 30, 40 years of anti-inflationary policies we're going to pivot away from that. I joined the Federal Reserve a month before Paul Volcker became chairman. I was there in Washington when all the action took place, and we beat inflation, and that was great. And I agree with Paul. We kind of overdid it. And now the pendulum is going to swing back. And it's important for all of us to think about that, what that means for investment portfolios. And in particular, It matters because, as I look out on underneath this tent, probably not a lot of experience with big secular inflations. Show of hands, how many people had a mortgage rate in their life above 10%? Yeah. For the millennials and Gen Xers, that can happen. And it might happen again. And you should be ready for it. Ask your money managers, what's their experience with inflation? Ask CIOs, what's their experience with inflation? Because what I hear when I ask that question is not a lot of experience. I hear answers that are fairly anodyne, fairly naive, fairly simplistic. Think about your portfolio, think about investing. When people talk about inflation, they generally start hyperventilating about bonds. Bonds are not the problem. If we get a significant secular inflation, the worst asset in your portfolio will be your equities. Because equities trade both based on earnings, but more importantly, valuation of those earnings. And that valuation historically has been far lower than it is today when inflation is higher. So if you think now we're trading US equities at a PE of 25, you go back to the end of the 1970s, early 1980s, that PE was 8. It was a third of what it is now. So even if earnings grow with inflation, you put a significantly lower multiple on those earnings, and equity returns are far more at risk of a pickup in inflation than bonds are. And I hear too many people saying the opposite. They'll say, well, your equity earnings are going to grow with prices. So no problem, it's an inflation hedge. But it wasn't in the 70s. Real returns were basically zero from the late 60s until the early 80s. Real price returns anyway. So it's not necessary. You're going to need to have them. As John finished up, equities are going to beat bonds until they don't. And I'm not making a timing call here. But there is a time at which you're going to want some fixed income in your portfolio. Ironically, even in an inflationary environment. Because the nice thing about bonds is they give you money back every year. And then you can reinvest that money at higher interest rates as interest rates rise. And your bonds actually give you your money back pretty quickly. 5, 7-year bonds are going to give you all your money back in 5 to 7 years. Growth equities with PEs in the 30s or above that, they're not going to give you your money back for 30 years. Who knows what it's going to be worth? So there's a role for fixed income absolutely in your portfolio. It's really interesting to think about alternatives because in the 1960s and 1970s, there were a few hedge funds, but it wasn't really a big part of the financial markets. There was no private equity industry. There was no infrastructure investment. Real estate was far smaller than it is now. So again, be very skeptical if someone has a strong opinion of how their alternative investments are going to perform in an inflationary environment, because they can't back it up with an historic track record. So again, you've got to be, I think, ask those hard questions, think through the answers, ask for evidence. One thing I do in addition right now is I'm a trustee of the retirement system over in Wyoming, and our consultant brought us some stress tests of what could happen in the market. And their inflation stress test was 6-9 months back in 1973, 74. That was a useful piece of information, but it really wasn't what we need to know. Because a secular inflation is 3, 5, 7, 10 years of rising prices, of higher prices, rising interest rates. What does that mean for your portfolio? You need to think of those kinds of stress tests, those kinds of simulations, and think that all through. So where do you go if you're worried about inflation, or if you want a part of your inflation to hold value? Well, we've talked about some of that today. I think gold, commodities, obviously gold is a long-standing historic hedge against inflation and depreciation of currencies. Tips are good in a stagflation. If real interest rates are low, if the economy is growing slowly, then tips are going to be, because they're going to pay you the inflation rate every year, a very good place to be. If the economy is stronger, and real interest rates are higher, and you've got a booming, an inflationary boom, then real estate, infrastructure, are assets that do reprice their income very quickly. And also, remember, real estate is a compound asset. If you own real estate, you typically own an enterprise, a hotel, an office building, a factory, but also the land underneath it. And it's the land underneath it that can hold its value and give you some protection in an inflation. And finally, short-term bonds. Actually, again, as I said, they will reprice as inflation goes up. They will give you income. They will give you the resources to deploy capital elsewhere or meet your obligations. So just in closing, I think about what Paul was saying, Paul McCulley, and Paul Ryan for that matter. But there are significant stresses out there. I think one way of relieving that stress that Paul McCulley was talking about is higher inflation. That's how income and wealth gets shifted from capital back to labor. And we have to think carefully about our own situation, our own portfolio, our own assets, and how to best protect them in the event that does play out. Thank you.
Did you do my slides?
Right here.
Could you do, I don't want to get John's risk. Okay. You know, at a certain age, you don't know how to work those things. Okay, you ready for the first slide? Okay, what I'd like to try to do today is put a little color on why I think that some pretty smart forecasters are correct. And I want to give a background why Paul McCulley is likely to be right from the standpoint of it's possible we have entered a regime change and present policies will encourage that. So the first chart is something I think is important to be a successful investor. Recognize what you're capable of. Okay, a big part of my speech is inflation, but I have two wonderful articles that say there's nobody been successful at predicting that. So I'm on a little bit of soft ground here. Two other aspects to that chart. There's nobody in this room that is invested in a boom. So we should be humble about what our capabilities are. As I look around the room, I expected that there was nobody that invested in a surging inflation environment. There look like there are a few of us around here. But still, one should keep in mind that that's not what the markets, the participants in the market see. So if you turn the page, what I want to do is to put a historical perspective on what I think is possible. Now, I apologize for this chart. This chart comes from a book written by Amy Shales called The Great Society. She's going to speak at a conference I have at the Darden School in November, and I asked to send that, and she sent it the wrong direction, so I don't have it today. But look at the structure. If you look at that, what you see is 1968, when I started in the business. I'm giving my age away. To 1980, there was no return. There was no return in bonds. There was no return in stocks. And the dollar was going down. So if you're a foreign investor, you were getting a negative return. And so I think that's something to keep in mind, possibly going forward. Now, next page. What was happening? Why was that condition existing? That was the first time we came up with the idea of stagflation. And so what we had at the early part of the 60s, the middle part of the 60s, we had a series of policy actions that were taken. They introduced the Sherman Antitrust Act. They introduced the Wagner Act, which gave more power to the unions. And then we came in with LBJ, who desperately wanted to achieve success in his war on poverty. So we had two stimuluses from the government. We had that, which started very small, and we also had the Vietnam War. So we were overloading the demand system. As you can see, we started with relatively modest inflation, less than 2, and we peaked out about 12. Now, I have trouble with the number of times I hear this word transitory. And one of the reasons for that is actions of government and also possible actions in various other sectors. What was happening there? If you go to the next page. Look at the dotted line. That was the government increasing its expenditures. And what started out relatively small, the War on Poverty by LBJ, it first became a community action thing. It then became a shovel money to the states thing. It then became shovel money to the states and localities. And then it became the Office of Economic Opportunity, which became a bureaucracy. And the problem that created part of our inflation was it went from the objective of outcome to process. They weren't having great success with the war on poverty. They were just moving people from here. That's when they got rid of the slums and they moved them over here. But they weren't creating a lot of jobs that got people out of their particular positions. So what the objective became over time was our measure of success will be how much money we spend. So for that 5-year period, the budget for the Office of Economic Opportunity just steadily went up like that. Now, why do I mention that? You know, in that picture, the economy wasn't, remember, the economy was okay. Sometimes it was strong, sometimes it was weaker. But what was really changing was the inflation aspect. And that's why I'm questioning this idea of transitory. Everybody that I read and talk to, there's been some pretty good people talking about it today, their perspective seems to be the last 20 to 40 years. And I think if you go back and you look at that time period, there are some conditions happening today which I think are possibly a forerunner of going down the same path. What have we just done recently? We have a head of the FTC, we have another head, I don't remember all of the people, but we have now the idea of a vigorous antitrust policy. The Biden administration has said our primary objective, first it was get more people employed, and now it has morphed into what will be the ratio of employment to population. That's a much more difficult and vigorous thing to change. But what I think you're seeing is you're seeing, we've heard this term, mission creep. We are having a mission creep come in to the spending part of the government. I think that will change the conditions that we have today, and therefore, it's, I think, unlikely for us to have inflation to go back to where we came from. Now, a couple of other aspects about inflation where I look at it differently. It's not my idea. One thing I try to do, I try to talk and read as many smart people as I possibly can. The most important thing I think about today, some of you may be familiar with Charles Goodhart, who wrote the book Demographics. He said the most profound thing about the 40-year decline in inflation was labor. What created that? There were 3 dramatic infusions of labor into the worldwide economy. The biggest, the most aggressive was when China joined the WTO. All of a sudden we have 1.3 billion Chinese into the economic system. And what has happened for the last 20 years, 25 years? Steadily more products are made in China, and prices have been capped. If you go back and do a word search, you could do it with the Fed or whatever. What is the most common word you hear about why inflation has been low? What?
Globalization.
Right. Why is that important? It's probably changing. So I think that is one of the things that would suggest inflation is not transitory. So if you want to... Now, back to the putting my investor cap on. Now, first of all, before I leave inflation, I'm not arguing that we go back to stagflation. I'm not arguing for very high rates. But I think if we have entered a period of time, inflation is higher for longer, that will not support the present level of the market. I don't know how many people can be in the same category. I'm one of the few people in my life and career have been through 5% average interest rates. Talk to anybody under 50. 5% is off the charts. Just think if we went back there. Anyway, Paul was talking about a regime change. I'm going to backpedal it. But part of that regime change is tremendous improvement in profitability over the last 20 years. And that's what that chart is trying to reflect. How did profits get to this level? You had lower interest rates for 20 years. You had lower taxes for 20 to 25 years. You had lower depreciation rates for 20 to 25 years. You've had lower labor costs for that time period. Wonderful tailwind. What would happen if that reversed? I'm in the category, a lot of people have learned today. I have to keep learning it. Don't fight the Fed. I'm going to respect the Biden administration that has a mission. And the mission is to increase labor participation and their wages. So you can look at that chart and I think each one of them will have a headwind going forward. Therefore, I think it's likely that we struggle in profitability, struggle with longer inflation. And why is that important? Unfortunately, there's one chart I don't have here, which is probably the most important. You may have seen it somewhere. If you take a chart, what should the valuation of the market be at various points of inflation? Most of the time you see 7 or 8 categories. There's almost no inflation, and there's the very high inflation. The fascinating thing, and Paul mentioned it, 8 times earnings at certain levels of inflation. The highest valuation on that particular chart would be 18 to 19 times earnings. And that is in very good conditions. I don't know where we are now, but we aren't even close to that level. It's somewhere between 25 and 30. So I don't think it, you heard this tent shaking a little bit. Just a little bit of wind could have significant outcomes. So as far as I'm concerned, I am personally planning for profitability will be disappointing for a longer period of time than people will be comfortable with, which is a problem because one of the major supports of the market has been rising free cash flow that can be paid out to shareholders. Suppose that stops. Now, just to finish off here. This is my rebuttal to Paul Ryan. I don't know if you can see that. It's a comparison of the Depression. Remember, one of the things that Franklin Roosevelt did, he kept doing things, he kept doing things, he kept doing things. There was no great success. But I saw a poll the other day that 70% of the people were in total agreement with the spending of the Biden administration. And that's what that cartoon is designed to emphasize. I think people are comfortable with the spending, and it's going to be harder to slow it down and stop it. Therefore, we get to, I think, more of a stage of support for inflation. And just one last thing I'd like to leave you with. This is sort of my own. Next slide. I had to say something about the Fed. I don't know how to say it diplomatically or whatever. By the way, is Dennis Lockhart here this year?
He was in the audience earlier.
Oh, chicken. Now, the reason I mentioned Dennis, I sponsor a Center for Asset Management at the Darden School at the University of Virginia. We talked to Dennis to come speak one year, and it was the year that the Fed was introducing their new tool, guidance, communication. That's how we will talk to the markets differently from Alan Greenspan, and maybe we can create greater stability. And I was thinking about that before I came out here, and then I read the speech the interview with Jerome Powell, and I would just like for you to read that and think about it. Is that going to get you to do anything? Does that help you feel comfortable about what they're doing? Sometimes you say, it's almost like when you invite your grandparents over to your house, you say, gee, we'll leave the room and they start talking because they won't stop. I think that's where we are with the Federal Reserve. And in difficulty, I think it will be harder for them to manage the present conditions. So there's a lot to talk about. I'll save where we should be investing for later, but thank you for your time.
So here we are in 2021, and we're going to talk about cryptos on the investment panel. And that's how far
It's here somewhere.
this space has come in a long time. So my time, I'm going to talk to you about the bullish long-term case for cryptos. To be a hodler is the phrase that they call it. Now, I'm going to assume none of you are Solidity programmers, that you probably haven't put money into a decentralized wallet, you haven't staked anything on a liquidity pool, you haven't borrowed on a lending platform, you haven't voted in a DAO, you have no idea what I just said. And so I'm going to give you the big picture without any jargon or technology as to what's going on in this space. Simply put, it's the next level of technology that's coming. I think it's as big as the internet itself and what they're trying to do. I mentioned it last night. It's doing what all technology wants to do. It's cutting out the middleman. In this case, the middleman is a bank, it's a brokerage firm, it's an exchange. And it's an alternative financial system that is being built without the need for them. And that's what's got the attention of the traditional financial system and of the regulators as well too. The reason that they want to cut it out is it's expensive, it's slow, and it's bureaucratic. And if you heard Jay Powell speak in the last 2 days, his answer is we need to make it more expensive, slower, and more bureaucratic because they want to pile more regulations on top of it. But let me explain what it is and what's going on. It is all about a thing called Web 3.0. We had Web 1.0, that was email back in the 90s. And the fancy word was that was peer-to-peer connection. That was your computer connecting to my computer and sending us an email. We currently have Web 2.0. That's the platform companies. That's the Googles, the Facebooks, the Microsofts, and the like. And they run gigantic servers, and all the information goes into their servers and gets fed back out to us. And there's a host of issues associated with that, not the least being censorship and a lot of others. Web 3.0 is to go back to peer-to-peer. It's to go back to decentralization. My computer talks to your computer. No one can get in the middle of it. And the way we're going to do that is we're going to use the blockchain. Now, I'm going to explain the blockchain without technology. The blockchain is a computer file that comes in one of two formats. It comes in a unique format, which is a non-fungible format, or it comes in a fungible format. In other words, my computer file on my computer, or my phone, or my laptop, my tablet, is unique. You can copy it, but it doesn't hold the properties of being unique. And it could be one of one, or it could be one of 100, whether it's non-fungible or fungible. What is the use case of having a unique computer file? One of them is money. We could turn those computer files into a form of value and trade that value back and forth, and that is a cryptocurrency. Another unique case about Web 3.0 with these files being run on the blockchain is, if nothing else, we're going to do away with all passwords, which is going to be tremendous for everybody. How's that going to work? Right. My computer on my phone will be unique to me. It's not hackable, it's immutable, it can't be changed. So when I connect to my bank, they know it's me because it's this phone. It's no different than me walking into the bank and saying, can I see what my checking account balance is? Same thing with my phone. Won't need a password because you can't copy my phone. You can't hack my phone. You can steal it physically, but then there's excuse me, there's safety measures associated with that as well too. Well, that's the way that it's going to work when it comes to starting to trade value across the internet. And by doing it in a decentralized format, we call these not platforms, but protocols. So we have lending protocols, we have borrowing protocols, we have trading protocols, we have insurance protocols, we have fund management protocols, all the way up and down the line. The first thing you need to know about it is there is no on and off switch. It can't be changed. So when Bill Foster, Democrat from my home state of Illinois, on the House Financial Services Committee said, you know, Bitcoin needs to have a way to undo a transaction so that we can go in and the government could tell them that those were bad people, that we need to undo that transaction. Fundamentally doesn't understand the technology. That is not possible for the way that it is constructed right now. The other thing you need to know about it too is no one owns it. They're usually run by a decentralized autonomous organization. And interesting, giving the speech here, there's only one jurisdiction in the entire world that now recognizes a DAO as a legal entity, and that's the state of Wyoming as of 2 months ago. And just last week, they gave some of their early outlines on what it would take to be a decentralized autonomous organization. All Bitcoin is a computer program, and it runs and it has no off switch. And if you want to change it, anybody can write computer code that says if enough of the people that own the tokens vote for this computer code will be executed. I'm trying to keep it as simple as I can. So there is no chairman of Bitcoin, there is no board of directors of Bitcoin to call in front of Congress or to dictate you must do this or you must do that. No one owns it. Everybody owns it in general. The government itself could put up what is called an improvement proposal and say, we would like you to change your programming so that you can undo the transactions. Great, then all the Bitcoin holders will vote no, and that will be the end of it. And there won't be any way to do anything other than to vote no for it. So this is what is coming, and this is how it's coming, and this is what makes the space so exciting, is it's a fundamental change in the traditional financial system, starting with there's no central authority in any of this if it is coming off as is hoped. And it will run without interruption. It can't be turned off. No one can own it. You could put up an improvement proposal. There are people like Vitalik Buterin, who is the creator of Ethereum, who he himself describes himself as a high priest, that whenever he says, hey, this is a good improvement proposal, it'll get passed because he thinks it's a good idea because he carries that much influence in the community as well too. And there's an issue about that and Elon Musk and whether or not that they have too much power. But this is the early stages of technology right now, and that it is a bit of a Wild West. And the one thing we know about early stage technology is most of it will fail. And just like in the 90s, most of the early internet companies fail. How you doing with your Netscape Navigator? How you doing with your AOL? All of that stuff, you know, MySpace. Where are you with MySpace these days? That stuff fails, but the stuff that doesn't fail becomes truly transformational. Hello, Google. Hello, Facebook. As just two examples as well too. And the same thing will happen in this space as well too, is that most of it will fail, but the rest of it will become transformational. So that you can own your own money without, because currently right now, let me give you a cold hard truth. Everybody's net worth in this room is zero, because you have all your money is held by a financial institution, and they've given you an IOU that says, this part of what we own, we recognize as yours, but it's not yours, it's really mine, the financial institution. And so in the new world, it's yours. It's yours in your wallet, and what we're talking about is the idea of private money, private property money. Instead of being issued by the sovereign, it would be issued by private property, and that's got a lot of people very nervous about what it potentially could mean, least of which Paul Ryan was talking about the reserve currency status of the United States should something take off and be successful from here as we move forward. So, as we go forward, there's going to be two narratives that go on in this space. Narrative one, you're probably all familiar with. I call it the magic bean narrative. It's whether or not Dogecoin or Bitcoin is going up or down and how much it rallied or declined today or tomorrow. Well, if you remember back to the late 90s, the late 1999, the late 1999, late 90s, we did the same thing with technology companies too. The B2B companies and everything else, they halved and doubled all the time as well too. And a lot of them, the Pets.coms of the world, the JDS Uniphases, some of them are no longer with us as well too. But that's exactly where this phase is. But then if you look past it and you look at what is being created, it is something that is quite extraordinary. How do you invest in it? That's a tough one. The best way to invest in it is to invest in it directly. As I've told people, this is a new financial system. You can't learn it in a 2-day seminar any more than a 19-year-old at college can say, I'm going to take a 2-day seminar on what is finance, and then I'll send my resume to Goldman Sachs and they'll hire me as an analyst. No, Goldman Sachs usually wants you to have an MBA before they'll take you as an entry-level position. It's going to take about that much time to understand this space too, so get started right away and learn it a little bit as you go. I find it personally to be the most fascinating thing in the 30-year career that I've done in looking at the macro space because it's so interesting and transformational, and a lot of people have been investing in this space as well too. And what you'll find is that when you buy a cryptocurrency and you move it to an electronic wallet and you trade it on a decentralized exchange and you lend against it and you borrow against it, you buy insurance against it, you could play a lottery against it, you could yield farm with it, which is buying and lending it to various protocols to try and get as high an interest rate as possible. All the things we can do in the current financial system without the need of an intermediary, you hopefully will see, if you get that far down the pike, that there's something here. It's still crude and it's still very early. And that's why I'm a long-term believer in the space. Now, one of the problems the space has is what's the best way to invest in the space? And a lot of people have come to the conclusion, like they did in the late 90s, buy everything. Because I don't know what's going to make it. 90% of it will go to zero, and the rest of it will be transformational. There's a famous tech VC investor, Roger McNamee of Elevation Partners. Got the name because Bono is his partner, or investor in his fund. And in a moment of honesty on CNBC, they asked him, well, what do you like? And he said, well, don't ask me. 90% of what I invest in goes to zero. And then the other 10%, makes him a billionaire, is what basically happens. And that's essentially what this space is. 9 out of 10 recommendations I give you will go to zero, and maybe the 10th one will go up 200x and make up for all of the ills of the first 9. And that's kind of the investment idea that you have. So you get a lot of fraud, you get a lot of speculation in this space as well too. So where do I want to leave you on cryptocurrencies in the time I have allotted, knowing the crowd I'm talking to is not a bunch of crypto programmers? This is an exciting new space that is transforming the entire financial system in ways that I don't think the regulators are even beginning to understand. The SEC has a lawsuit against a cryptocurrency called XRP Ripple, and they've accused it of being a security, not a currency. And in the lawsuit, XRP Ripple is pressing the SEC real hard to give them a definition of what a security is, and I don't think the SEC can actually do it. They don't really have it figured out yet. This is how new this stuff is. They're like the Fed when it comes to transitory. We don't want to define it. We want to leave you in the dark so we could selectively, punish people for having securities and selectively ignore others as well too. So this is the problem with this space. It's so new and it's so different, but I don't think it's going to go away. And finally, what is it's trying to solve? At the end of the day, the banking system is inherently broken, and yet we don't see it because in our position, it doesn't appear to be broken to us. The majority of the world is unbanked. The majority of the world is unbanked because banking is too expensive for them. Cam Harvey at Duke University has a little image of a Western Union telegram transfer, 1873, what we would call a wire transfer, they called them a telegram transfer back then. Somebody wanted to send somebody $300. It says $300, $9 of fees, $309, a 3% fee, and they promised you'd get it in 2 to 4 days. They had to put $300 in a saddlebag and have somebody with a horse ride it to you to get your $300 in 1873. In 2021, a wire transfer costs 3%, takes about 2 to 4 days. There's been no improvement in 150 years. There are 1.7 billion migrant workers around the world that work in a different country and send their money back to their family. They have to pay somewhere about 10 to 20% fees in remittances to send their money back. They work 1 month a year to pay the bank. So when Panama said, we're going to make Bitcoin an official currency, one of the reasons cited by the president is 70% of the Panamanian population doesn't have a bank account. So if they could use a crypto wallet to transfer the money to their loved ones, they can save that 10 to 20% right off the top, and maybe even have a savings vehicle as well too. Even though crypto is very volatile, at least it's a start. The unconscionable thing is they asked the World Bank last week to come in and help them with this, and the World Bank started off with it's dirty energy, it's all drug dealers and ransom, which I think is wildly overstated as well too, and no, we're not going to help you. I'll just say in 2 words on the last 2, and then I'll stop because I'm running out of time here. As far as the dirty part of it is, yeah, it is very energy intensive, but if you get into the space, you'll see that there's more ideas to reduce the energy consumption than you can get your head around. And in 3 to 5 years, the energy consumption is going to be vastly, vastly lower than it is right now. As far as being the haven of drug dealers and ransomware, the only thing I'll say about that is the most ineffective laws I think we have currently in the United States are the KYC AML laws. They really are ineffective against stopping much of anything when it comes to illegal transactions or ransom or anything else. The Bank Secrecy Act is just nothing but a giant cost with very little benefit. That's not to say that there isn't any illegal transactions going on in the crypto space. There is. But if you got rid of the crypto space, they're perfectly fine with the traditional financial space because HSBC still exists. Oh, I didn't say that, did I? As far as if you know anything about their history, you know exactly what I'm talking about. So anyway, the crypto space is new. It's coming. It's very exciting. It's going to change the very face of finance. As I said last night, I'll conclude with it again. I think the United States has to understand it's going to happen in one of 2 ways. It's going to happen with us, or it's going to happen without us. And the more that the World Bank wants to say, it's dirty, it's ransomware, we're not going to help you, Panama, fine. They'll call the Chinese and they'll help them with it. Otherwise, if we want to help them with it, we could be part of this process and instead of letting this process be imposed upon us. I'll happy to answer any questions you have about it in the Q&A. Thank you.
Okay, I think we have time for maybe just a couple of questions. So we have one right here. We'll bring a microphone up.
Hi, this is Mike, and this is for Jim. So here's the question. It's really a tactical skin in the game question, which is, when you look at crypto right now, the first question is, are you personally investing? And I'm just going to ask the hard question, which is, what percentage of your net worth are you willing to commit and have skin in the game? And are you looking at it right now and investing on the basis of the utility value of the token versus the asset value of the token?
So the first question is, yes, I'm investing in it. As far as the amount of my net worth, I've always answered the question this way. If the space went to 0 tomorrow, my lifestyle doesn't change. And that's the way you should invest in a highly speculative technology. As far as what I do in this space, all of the above. I buy tokens based on what's known as their tokenomics, the incentive plans that they have. I have lent my tokens, I have borrowed against my tokens, I have traded my tokens, I've bought insurance against my tokens. I've done all of that to try and get a better understanding of the space. I'd suggest that In the digital space right now, it's digital. You could start with a few $100s if you want to. Call it an education fee. And just try and get in and understand what's going on. The Coinbases of the world do a very good job of basically trying to get you to go, get you started in this field as well too.
This question is also for Jim. Can you describe how crypto mining works? That seems very confusing for a lot of people. So.
Okay, so there are a bunch of computer programs that have to process the transactions on a cryptocurrency on the blockchain. They're referred to as miners. There needs to be, the phrase that they use is a consensus protocol, right? We've got thousands of miners that run the blockchains for, say, Bitcoin or Ethereum. How do we pick which miners do what transactions, and how do we prevent collusion among miners in order to manipulate the system? So they use a consensus model which is called proof of work. And basically what that means is all of the computer programmers, the miners, they run a computer puzzle. They solve for this puzzle of these sophisticated algorithms. It takes an enormous amount of computing power to do it. And when you've got the puzzle solved, you're next in line in order to process a transaction. And in the case of Bitcoin, you get paid 3.5 Bitcoin to process a transaction currently. And at current prices, that's about $100,000 or so for your troubles. So most of the energy use comes in solving these crypto puzzles as well too. There are other ideas on what's called the consensus protocol, which is called proof of stake, which is the Ethereum network is going to move to hopefully next year. That will be much less energy intensive as well too. But what you need to understand about the mining operation is it's set up in a way that no one can take it over, no one can manipulate it. And that's why they go through all of these complicated consensus needs in order to keep the system fair. Last thing real quick, I mentioned this last night about the Chinese shooting themselves in the foot. They're so high on their digital yuan that they're chasing all of the miners out of China. Roughly, no one knows for sure, but maybe up to half of all the crypto mining was taking place in China. It's almost all out of China right now. They're literally closing up, packing up, and going to other countries as well too. They're doing the world a giant favor. There was always a fear that if all the crypto mining was going on in China, that somehow the Chinese government could force or coerce all of them into some kind of a manipulation of this network. Fine, if you're going to send them to Texas or Kazakhstan or Europe or Florida or Panama and use volcanoes as your energy source, which the president of Panama said a couple of weeks ago, it's not China and they can't manipulate it. They're taking themselves out of this game because they're so sure that their digital yuan is going to become the big successful currency.
Okay, let's get a couple more questions in. Yes, sir.
For Jim also. So we're winding down to the last several million Bitcoins. Do you see the 21 million limitation as an inherently positive thing and sort of an intrinsic value factor that comes into this equation? That's part one. Part two is the transactional difficulties with converting Bitcoin and some of the others back to fiat currency if you want to spend without trying to spend Bitcoin directly. Is that a focus of the technology to try to level that out and speed it up?
Yeah, so the first one is, one of the things that people like about Bitcoin is it has a hard cap of 21 million Bitcoins will be issued, and that's it. The estimate is that by the year 2140, so 21 years from now, 19 years from now, I get my math right, we will have issued the last Bitcoin. There is some concern what happens with mining when there's no more coins to pay the miners to continue to do it, but hey, that's a problem for 19 years from now. That's not a problem for right away. So that's, yeah, I think it's good. They refer to it in the space as the inflation rate, and that the inflation rate on Bitcoin is fixed. They rail against the libertarians and the programmers in the space rail against the Federal Reserve and fiat money printing as well too as being a big problem that they're thinking that they're trying to solve with this space by having more of trusted or hard money, by having some kind of a limitation on not only Bitcoin but a lot of the other cryptocurrencies as well too. And to the second half of your question, there are stable coins in the space, and those are coins that are pegged to another asset, one for one, Tether being the big one. They're getting a huge adoption, especially in Asia, as a form of payment. If I'm this is an exact example, if I'm a Vietnamese manufacturer and I have an Indonesian supplier, and I owe my Indonesian supplier the $50 million for input, raw materials that they sent me this month, because it's all priced in dollars, I can go to my Vietnamese bank that can convert it to the Malaysian ringgit, and I could be feed, tax, report, or I can open a crypto wallet, you can open a crypto wallet, and I'll send you 15 million of Tether in about 3 seconds, and it'll cost me a couple of pennies, and the transaction is done. That's what's got the attention of central banks. All of a sudden, we don't need them anymore. We don't need banks anymore to affect international payments. This is on a very small scale that it's happening, but we could see where this is going to continue to go if it continues to grow apace. And that's why the Federal Reserve in April said, oh, we're going to take a couple of years before we figure out what to do about a central bank digital currency, which is a stable coin, to we're going to have a report out in September on a central bank's digital currency. They've seen the sirens go off that they got to start moving a lot faster on this before the private sector picks up for them.
So I hate to bring this back to 2021 with a really boring question, Dick and Paul, to both of you. John Sylvia shared with us the relationship between yield curve and margins. What's the relationship between inflation and margins? And Dick, maybe you could speak to how you expect corporate margins to evolve over the coming 12 to 18 months, and how do you invest around that? And Paul, same to you.
For me, it's pretty simple. I think we are at an inflection point. It's interesting, in terms of profitability, I look at profitability today as one grand extrapolation. People are seeing GDP go that way, profitability must go that way. Well, if you spend time over, looking at corporations, the first and most profitable phase is when you're coming out of a recession, you're shipping your products that have already been built and you're not paying anything. So I think we're about to hit, in the next two or three quarters, a different page. This massive operating leverage that we're seeing, I think will hit reality. The most obvious thing right now is look in the paper every day. There's a surge of wage increases. I think that continues because we have a mismatch in terms of where people are in the economy. So that's the pressure. So I'm much more pessimistic about margins. And one thing you need to break the economy down, corporations down in two categories. The most significant surge in margins has come from the internet companies, the Microsofts, the Googles and Alphabet. The others, they went up, but not to the same magnitude. So if you split them apart, I think you're already beginning to see pressures on what is called the old economy. And I'm also a believer that at some point in time, the 10 largest companies that now everybody has grown a great dislike for will have steady regulatory pressures. So that's going to affect them. How do you invest in this particular environment? I've said it so many times now. In the last 10 years, everybody went to passive indexes. To me, the mantra is you have to have an idiosyncratic portfolio. The minority of companies will be able to, only a minority of companies will be able to overcome the pressures that you're talking about, and that's where you should focus. Some people will have an ability to maintain margins because they're business, some won't. But at some point in time, I think we get to say, there's one key point I'd like to say. Today's corporate executive assumes he can increase his costs with price increases. I think that will be tested.
Paul?
A couple of years ago, Bridgewater Associates did an analysis of how much rising profit margins had contributed to U.S. equity returns over the last 25, 30 years, and they came up with a number of 2%. In other words, if profit margins had been steady since the 80s, equity returns would have been a couple of percentage points lower. So that's big. So going forward, and I think this is what Paul McCulley was saying, is that a continual rise in profit margins just isn't credible. So that we've got kind of two futures, one where they stabilize and equity returns are a little bit lower, and one where they reverse and more of the GDP flows to labor, less to capital, and then profit margins shrink and equity returns will be materially lower. So for investors, this is the key thing to watch. Watch things like increases in corporate taxes. Watch things like increases in labor costs, and so on, because if that pendulum starts swinging, it can have a big impact.
Great. Well, please join me in thanking our panelists for a great conversation. Thanks for your attention.